Hi, this is Kevin from Infiniti, and I just wanted to go through a few things with you about wealth creation that I think are absolutely fundamental to planning your financial future. So a lot of people ask, me, what is it exactly that Infiniti does? And what we do is we buy commercial property in the United States to help mainly South Africans, but other people around the world develop a dollar-based income. So if you're anything like me, I love South Africa, I live in Cape Town, I live in one of the best places in Cape Town. It's the most amazing lifestyle here. It's like 10 minutes to the school, 10 minutes to the beach, it's 10 minutes to my office. And I always tell people the only thing that could make it better than that is if I could earn a dollar-based income. And that's really kind of why Infiniti was born. So we invest and develop commercial property in the United States, and we syndicate to high net worth South Africans in order to develop a dollar-based income. We've done lots of projects in the United States since 2011 when we first started investing in the United States, all the way through to today. We've done $150 million worth of transactions in the last 2 years. And prior to that, I had invested in many projects in the United States to understand the market. I think what's really important for me to get across to you also is that, all of us probably who have some sort of wealth advisor or family office that, we work with, or whether we've got some people who in the financial world and do some financial planning for us. The challenge for me with that is always been that it's always been fee-based and not performance-based. And I don't know about you, but I'm totally allergic to that kind of business for a very simple reason that I'm happy to pay people a nice, big, healthy piece of the back end, provided they're providing me with outsized returns. So Infiniti's philosophy has always been very, very simple. We believe very much in performance. We believe in backing our own due diligence and backing our own product. So we've always focused our energies around performance-based fees. The first 6 to 8% of all our projects go to the investor. Anything above that, we split 50-50 with our investor. So our investor gets 50% of that. The other 50% above that hurdle rate, we then split again with our partners in the United States. So I think it's a very healthy model. It keeps us absolutely incentivized all the way through the program. I think it's critical that for us as your wealth manager to make sure that we are pushing those assets as hard as possible to cash flow as high as possible, and that we're getting and experiencing as much capital growth as possible, which is absolutely critical to where we make money. So all the way along, our incentives and the investor incentives are aligned. We always put our own money into all our projects as well. So our money and the investor money sit side by side. Our partners in the United States put their money into the project. It's an absolute must, and it's a mandate of ours to make sure that that happens as well. And we focused around win-win. So we are all fighting really hard to make sure that the cash flows high and expenses are low, and we experience as much capital growth as possible so that we can all benefit at the end of the day. And that's how we make money. We make money really, at the end of the day on our performance and the exit. So most of our projects are usually a 3 to 6 year hold. There's not much liquidity in the projects that we do. We have had circumstances where some clients have asked for their money to come out, and in all of those cases it's been absorbed by the existing group of people involved in the project. We set up a special purpose vehicle for each product and for each project, and everyone becomes a shareholder in that project pro rata according to their investment. So it's a very clean, healthy way to do things. It's been a really, really amazing experience working with the teams of people that we got in the United States, and I think we do some really great projects and exciting businesses that we look at getting involved in there too. So I think, really at the end of the day, if I could talk to you about a little bit more about the philosophy of Infiniti and why it came about. We live in an amazing place, Cape Town, South Africa. I lived most of my life in Australia, or half my life in Australia and half my life here. I was born in Bloemfontein, left when I was 8, immigrated to Australia, became an architect in Australia, and came back here in 1997. I love this place. I love Cape Town. I love South Africa. I just don't love the uncertainty of where the future is going to be. And I think, like most South Africans, we have to plan wisely for the God forbid strategy, or the God forbid circumstances, and have a God forbid strategy. So God forbid half these lunatics that we listen to on TV do some of the things that they want to do, and we have to lock the door, drop the keys, and get the hell out of Dodge, and just want to maintain the same standard of living we have here in South Africa. one of the things that I think is absolutely critical, that if you've done well creating wealth here, I mean, most of our clients are really good at making money here in South Africa. So this, I think South Africa to a large extent is the wealth creation model. And what I'd like to say about what we do in the USA, it's your wealth creation / preservation model. Because sometimes you're fighting against things that are very difficult to fight against, that are absolutely out of your control. So Infiniti was set up just in case, like, you know, I've got 3 children, you know, I want to keep them in a private school. If I had to leave here and I needed to go maintain that same standard of living anywhere in the world, I'd want them to be in private school. I want to take out my wife for dinner 3 times a week. I'd like to shop at the equivalent of Woolworths or Pick and Pay. At the end of the day, I'd like to be able to be, you know, have a reasonable car, nice house, and be able to travel 3 or 4 times a year. So to be able to maintain that same standard of living overseas, I would have to create a $20,000 to $25,000 a month income. And the only way that I can do that is to build an asset portfolio of around $2 million, because, you know, we want to be getting a 10% cash on cash return as our target of income. So we want to build that portfolio for me or for you or for anybody else, and we build that portfolio over a period of time, depending on how liquid you are and how much money we can get out of South Africa through the, you know, the regulated means, and build up a portfolio over time. So all of our clients, we never see them as clients, we always see them as partners, because at the end of the day, they are partners. They're not being charged. They're being, you know, for the work that we do, we charge for performance that we create. So I think it's very important that that strategy is in place, both from your point of view and from our point of view. And what's even more critical is that we set up the right systems and the right programs to be able to work forward into the future. So at any one time, you can go into your private portal that we set up for you. You can have a look at all the investments you've made. You can have a look at where, how much of your portfolios and different assets and how it's yielding at the moment, and all the documentation, everything we do with you sits on that portal. And effectively what Infiniti becomes over time is your partner or your family office, your own family office, and we work together with you to be able to manage your wealth, to create the God forbid strategy for as a bit of a hedge here in South Africa. It's amazing how differently you live here. You watch all the political stuff that's going on here, and it takes a lot of the edge off your life when you know you've got that strategy in place. So that's really what Infiniti was set up for. The second thing that I really want to maybe go through with you today, which I think is absolutely critical to understand in understanding Infiniti and why we chose the USA as a jurisdiction, is that if you compare a South African model and a US model, and you wanted to really understand property from what would be the difference between investing in property in South Africa and investing in property in the US, or, you know, in a lot of other jurisdictions around the world. And maybe if I can use an example here, is that if you bought a 1 million rand property in South Africa currently, you're going to put down $300,000 of that will be your cash or your equity. $700,000 of that's going to be debt from the bank at about 10.5%. And I call the strategy in South Africa the hope and pray strategy. And the reason why we call it the hope and pray strategy is very simple, is that if you look at all the expenses that cost to run a property, so you've got debt, obviously, you've got rates, you've got levies, you've got taxes, and you've got maintenance. So I call it the hope and pray strategy, because your hope is that the income of that investment, that million rand investment, the income of that investment will cover your expenses, and you pray for capital growth. Because South Africa is a high inflationary environment, we would expect that you'd have good numbers in terms of capital growth. Recently, obviously, that's been a little bit different. I mean, South Africa is in an interesting time right now. The first time since I've been here, since 1997, that I've seen property prices on the seaboard come down 15% or in some cases 20%. So it's an interesting time we've got right now. But what I'm finding even more fascinating and interesting is that, you know, people think we make money in South Africa and have done well over the last 5 years in property. So let me give an example. If you bought something for R1 million and 5 years later that thing's worth 2 million rand, the question is, have you made money? Well, it's an interesting question, because if you remember, if we go back to the hope and pray strategy, you know, you're hoping that your income from that asset covers the expenses, which we know it doesn't. So you're actually having to put in, we call it negatively gearing here, 5 to 10% a month to cover the shortfall. And the pray is that over a 5 to 7 year period that you'll move out of the red and you'll go into the green. So people in South Africa over a 5 year period thought they bought something for R1,000,000, that things now worth R2,000,000 have done really well. Well, have you done really well? The question is, how do you measure wealth? And I think if you've got to measure wealth in a smart way, you have to measure wealth in dollars. So let's just analyze that for a second. In South Africa, over the last 30 years, if you take the last 30 years history, the rand has depreciated against the dollar at 6% per annum. The other thing that we're fighting in South Africa over the last 30 years, again, if you look at the stats, the cost of living, inflation in South Africa is also at 6%. So obviously those two do influence each other to some extent, so it's not going to be a total 12%, but let's round it out to a 10. You'd have to be 10% compounded ahead a year to be able to just break even on your investment. So over a 5 to 10 year period, if you take that into account, you bought something for 1 million, 5 years later it's worth 2 million. Have you made money? Well, when you take into account how much you've had to put in terms of the negative gearing, if you take into account closing costs and CGT, you'll be lucky if you're at zero. So you haven't actually made money, you're at the same level you were 5 years previous. Bit scary, but that's the reality of the South African view. If we take the exact same view with the USA, so if you bought something for $1 million, same scenario, you're going to get $700,000 in debt, $300,000 will be your equity or your cash. The difference is obviously you're borrowing here at between 4.5 to 4.75%, which already is an absolute game changer. And if you think about this for a minute, after expenses, after debt service, after rates, levies, taxes, after all of that, that asset in the USA, or the ones that we buy, would be producing a 7 to 8% cash on cash return. So on your $300,000 equity check that you put in, you could expect to make about plus minus $25,000 a year in income. Now that's already amazing. If you look at, let's compare the South African view and the US view. In the South African view, you negatively gear 5 to 10% a year for the first 5 to 7 years. And in the US view, you 7 to 8% cash flow positive after expenses, after debt, after taxes. You cash flow positive on your cash investment. That's amazing difference. Then in the USA, which even gets me even more excited, I call it the 3 magic beans. And the 3 magic beans are incredible. The first one is depreciation. So on the big blocks of flats, multifamily assets we buy, you can depreciate that asset over 27.5 years. So what does that mean in real terms? Well, in real terms, let me use an example of one of our latest projects. We've bought 140 apartments in Atlanta. It's already 100% leased. So we bought it at just over a 6 cap. And what does that really translate into after you add debt to that? Is that asset is producing for our investors 7.1% from day one out the door. And because we've got depreciation in our camp, because we've got depreciation as a write-off, what's interesting is if you take the net operating income of that asset, today is producing $460,000 a year net operating income, and our depreciation number is $450,000 a year. So what does that translate into? It means that the income that we're creating out of the project is offset against depreciation. The capital growth, therefore, after depreciation is $10,000. And on a $460,000 income, we're only having to pay tax on $10,000. And your tax return in the USA, you write down as a line item, free cash flow. It's an accounting term. And it means that 7 to 8% that we're cash flowing out the door, offset against depreciation, is free cash flow. Now the US government's also very smart, so they will recoup this on a sales event or a liquidity event. This becomes the second magic bean. So the second magic bean is a thing called a 1031 exchange. So when we do have a realization event and we sell that property for whatever we sell the property for, and we've got a big capital gains event, the government will try and recoup. But the beautiful thing about the US is you get a thing called the 1031 exchange. So if you allocate those funds for redeployment into another project within 6 months of sale, you can defer your capital gains. And that's amazing. I mean, we've got a couple in the USA that we've been working with. It's a family, they've been operating in the US for over 100 years. For 95 years, they've been deferring, 4 generations. So can you imagine that for 95 years, you've been growing your asset portfolio? Imagine if SARS said to you, you've done so well with the money, just keep going. We're not going to get it from you. We're not going to get it from your children or your grandchildren. We'll get it from your great-great-grandchildren one day. But you're doing so well, keep going. Use the money to keep growing the wealth, and we will, we'll get our cut later. It would be amazing. So that's the beautiful thing about this 1031 exchange, is that you get to work with all your money, all your profits. If you're smart about it and we do it correctly and we do it through the right mechanism, there's an opportunity for us to defer our capital gains into another project and keep working with that money. And we're getting that 7 to 8% annualized cash flow, maybe even higher, depends on how we do our part on the back end, to maximize our depreciation number and maximize therefore our free cash flow. So that's really exciting. Is the second one is the 1031 exchange. And the third magic bean in the USA is Trump, believe it or not. God bless Trump. The man is a unique animal, to say the least. But what's beautiful about what he's done is he's taken corporate tax and dropped it from 35% to 21%. So on that example I explained to you earlier, where we had $460,000 a year net operating income and $450,000 a year depreciation, and we had $10,000 of net income, we're only paying 21%. So you're paying $2,100 tax on the $10,000 income on a $460,000, net yield on the project. That is amazing. So, what it's taken me a long time to understand, and hopefully I've delivered this message as clearly as possible to you. I remember reading a quote from Einstein once. He said, if you can't explain it simply, you don't understand it well enough. And if I take what I've learned over the last 8 to 10 years in property and synthesize it down to one beautiful example, is that if you take the South African view and you take the US view and you take the time to understand it, it's almost impossible to invest your money in South Africa anymore in property, because it's so beneficial to do the US model. It's incredible. So again, one of the things I just want to highlight is, why would you want to choose Infiniti as your wealth manager or your offshore wealth advisors? We're not advisors, we're managers. We're doing projects. We've got a small network of people that we work with. They're all people that we know, or people who we know who've referred. And we work together as partners to be able to do amazing projects. We found that together we can do a lot more than individually. Some of my partners and I have done some projects on our own, and where it's much more better and much more lucrative to do projects together, because we get the benefit of scale, and scale enables us to reduce our expenses and increase our profits, which is really what's exciting. So there's a benefit to everybody, and it's really our philosophy has always been around how do we work together to tap into each other's strengths to be able to maximize what we can do together. And that's really the philosophy of Infiniti. So we love what we do, we're passionate about what we do, and we'd love to be able to help you do this similar to what we're doing. So book some time with us. Myself or one of our other partners can come and sit down with you and talk to you about what we're doing and what projects we've got live right now, and how you can tap into this amazing opportunity. So maybe I should just share with you quickly a couple of projects we've got live right now. I think they're quite exciting. They're two very different projects. One's a redevelopment of a cotton mill. It's in South Carolina. It's in a beautiful area. The cotton mill was built in 1913. It was the biggest cotton mill in America when it was built. And we're converting it into 303 apartments. It's going to be a beautiful, beautiful product. It's got 1.2 meter thick brick walls. So on the day that we were there, it was like 40 something degrees, and you walk into the mill and it's cool as a cucumber. It's going to be one of the most high-tech products in the United States. So from your cell phone, you'll be able to control the opening and closing of the door, your kettle, your toaster, your fridge, your Wi-Fi, your electricity will all be controlled from your cell phone. It's going to be a massive site. So one of the things about this kind of product is it's also about the value add opportunities, or the amenities package you get besides your rental. What else do you get? So it's going to have a beautiful outdoor lake, which they used to use to clean the cotton. All the environmental reports have come back that it's clean and it's all good, so people can use the lake. It's got its own lake. It's going to have it's a beautiful pool and pagodas outside the pool area. It's going to have its on-site brewery. It's going to have a dog groomer. It's got a 24-hour gym. It's got a restaurant. So it's going to be an amazing place. It's also got on-site storage, different storage facilities, and a beautiful banqueting area for events, weddings, and town events, etc. It's 44,000 square feet, this place, which is about 9 football fields. It's massive. So from your cell phone, you can actually check the gym to see if the machines are available for use. You can order a beer from the craft brewery. You can check the pool to see which pagodas are available that you can book for yourself or your friends and family that are coming over. It's amazing. So it's going to be a beautiful product. We've got amazing value add to this project is we were able to negotiate over $20 million in tax credits, which effectively is a government grant. So it's enabling us to be able to produce a very high quality product with much better finishes, but still coming at a reasonable price. And it obviously then adds a big profitability to our bottom line. It's a $60 million project. I think it's very exciting, the opportunity there. That will produce a 20% or north of 20% internal rate of return over the 4 to 6 years, which is a compounded return. And I think that's a beautiful project. And the other project we've got right now is the one I spoke about in Atlanta. It's a little bit of a different project. It's already de-risked to a large degree because it's 100% leased. It's in a great area in Atlanta. It's just on the edge of the Golden Triangle, which is where all the growth is happening in Atlanta. We love Atlanta because obviously it's a gateway city. It's a home of Delta. Hartsfield-Jackson Airport is the busiest airport in America, in the world in fact, and 450 of America's Fortune 500 have got some sort of head office in Atlanta. So it's a beautiful gateway city. From there you can get basically anywhere in the world. It's got a very diversified economy. In fact, where the site is, this Alturas Embry Hills, is 2.5 miles from where they're building the biggest movie district in the United States. So that's I think it's a $7 to $10 billion project over the next 15 years. So if you take a macroeconomic view, that area is experiencing outsized returns. Our model there is that as the leases come up for rent, we're going to renovate the apartments and uptick the rental. So we took ownership of it a few months ago. We've already increased the rent between 8 and 13% to be able to get people out so we can do the renovation. What was interesting is in the first 2 months of renewals, no one's wanting to leave. So we call it champagne problems. Why is it champagne problems? Because we've lifted the rent to an outsized number to be able to force some tenants out so we can do the renovation intervention and then do another rental uptick. But what is amazing is that we bought the project right. We bought at a good price per door. The rent per square foot was below market. It was not badly managed, but there was less management efficiencies than we bring into it. So if you take all of this into account, it's all very exciting for the project and the future of this project. So talk to us about that one too. It's a very exciting project. Those are the two we've got live at the moment. We're in due diligence with 3 or 4 other projects which we'll bring to market shortly. So it's very exciting from that point of view. We try to bring on a deal a quarter or a deal a trimester. And so there's always going to be lots of opportunities for you as we keep going down the road for you to say, yes, I like that one, I'll take a stake in that one, not that one, I like that one. And over time together we will build a beautiful portfolio, diversified portfolio of great income producing dollar-based assets. So I would suggest that you book a time with us, book a time with the person who invited you. Let's sit down, have a chat, show you what we're doing, meet the team. Come with us on a trip. I mean, one of the best things I've ever seen is when we take investors with us on a trip. Once you see our projects, once you meet our partners on the ground, once you see how we communicate with our investors, how we do things with our investors, you will be blown away. And I haven't really taken, I think we've had one client over all these years who's come on a trip with us who hasn't invested. So if you want to do a really proper due diligence, come with us on a trip. One of us is there once every 3 months, one of us is there. So come with us, come and see, come and check it out, walk the road with us, and we look forward to having you as a partner in this program and look forward to doing some amazing things together over time. Thank you.